we've seen it where people can get a $25,000 loss on paper from that rental property. Now, instead of paying taxes on 100 grand of income, they're only paying taxes on $75,000.
What's going on, everyone? Welcome to another episode of The Remote Investor. I'm Michael Albaum, and today I'm joined by a very special guest. I know I say that all the time, but really, for real this time, a very special guest. Matt MacFarland is going to be talking to us about what we as investors need to be aware of when it comes to tax planning and tax strategy, as well as preparation. Because it's not all about looking in the rearview mirror. There are actually things we can do today to prep tax-wise looking into the future. So let's get into it. Hey, everyone, just a real quick favor. If you wouldn't mind, take 2 seconds and go like and subscribe to the show. It helps us reach more folks. If you're here listening, that hopefully means you like the show. Or frankly, even if you don't like the show, leave us a comment. Let us know what you don't like about the show. Help us grow, help us get better, help us reach more folks. All right, let's get back into it. Hey, Matt, welcome to The Remote Investor. Super excited to have you on here, man. Thanks for hanging out with me.
Good, Michael. Thanks for having me on again.
Oh, my pleasure. My pleasure. It's going to be so much fun to chat with you today. It's always fun to chat with you, but today is, I think, going to be extra fun because of where we are given the current conditions in the cycle. So for anyone who maybe isn't familiar with you, give us a quick and dirty who you are, where you come from, and what is it you're doing in real estate today?
Yeah, I'm a CPA and real estate investor by trade. I've been in the CPA industry for over 25 years. Our CPA firm, Keystone CPA, we specialize in working with real estate investors all over the country on proactive tax planning, basically kind of help you keep more of that hard-earned money so you can reinvest it. And, our clients use real estate as their primary wealth vehicle, obviously, but it's what we love. We love to educate people and talk to people about their real estate plans and how they can use tax strategies to kind of, supercharge their wealth building. So excited to be here.
Amazing. And that's exactly what we're going to do here today. So Matt, just like straight out the gates, what's the one thing that you see new investors get wrong when it comes to tax planning with regard to real estate?
I think the biggest thing that probably new investors get wrong is just really, I think we talk about a lot of times is the foundation of good tax planning is making sure you've captured all your deductions. I mean, as unsexy as that might sound, right? Like, it's so commonly true. Like real estate investors, they're good at like, hey, I got mortgage interest, I got property taxes, I got insurance, like that stuff that's tied to the properties, right? But it's all those other costs that people are running their real estate business, they're running a brokerage, whatever it is, those overhead costs of, hey, I'm going to this conference, I'm having a business meal with this person, I'm traveling here, whatever those other things that are not tied to properties that I think get overlooked a lot because of, they don't know they can deduct it, they don't know, they don't have a good system to keep track of it. All the reasons above, right? So yeah, I think that's probably a good first step that I think people make mistakes on is just not capturing all those things because, it's either going to help you now or it's going to help you in the future. But if you never capture it, it's never going to help you, right? So
Totally. Well, I think so many people, as they first get started investing, don't understand that it's like a business unto itself. And so don't treat it as such. And so, like you said, they know the table stakes, the property taxes, insurance, taxes, because the lender will probably be collecting on their behalf and tells you, hey, this is how much you paid. But for all the other stuff, they're maybe not used to running a business. So they totally miss it.
Right. Yeah, no, that's so true for sure.
So what have you seen work really well for folks in terms of systems, especially for those who are just getting started? They're starting from scratch. They don't have any bad habits, but they need help figuring out, okay, how do I capture all these expenses? What do you recommend people use?
Yeah, we tell clients, obviously clients and investors know themselves better than anybody. So if you're somebody that, I don't know, likes to use paper still for some reason, and God bless you and go ahead and do that, but, a lot of our clients, use apps. There's lots of apps out there. Excel is a great way to track income and expenses when you're just getting started. You probably don't need like QuickBooks yet or something that, quote unquote advanced, right? So, just using simple templates like that to capture the expense. The beautiful thing nowadays is like, we used to have to keep like paper copies of receipts and put them in file cabinets and all that kind of crap, right? That you don't have to do that anymore. Most people, the IRS will take, you can take a picture of your receipt, store it in a, digital folder in your computer, hey, this is for this property and this goes in February folder, something like that, where you just kind of get that system that you're going to stick with, that you're going to keep up with. And again, that could be apps. If you're somebody who's technologically advanced and that's easy for you, then go for it. But just find something that you're going to stick with. I think is a big key.
Yeah, no, I love that. And I also love the fact that you said Excel, because I was like gonna have to be so embarrassed if you didn't be like, well, actually, Matt, I use Excel. So
No,
I
yeah.
I love that you mentioned it. And it is like you touched on it. It's so easy if you understand Excel. Even if you don't understand Excel, it's like one of the easiest, I think, programs to use, because when you pay an expense, you just go in there, you throw it in, and then you're done. Versus having to keep track of going back at the end of the year trying to reconcile, oh well, what was this expense? I see on my credit card it was $300, but I don't really know what it was for. So I love that. Find a system that works for you and then just stick to it.
Yeah,
That's
for
great.
sure.
And so, okay, you talked about tax planning, which is maybe a new term for some of our listeners. Everyone is probably familiar with tax preparation, which is what you do at the end of the tax year. But talk to us a little bit about what tax planning is and what should that be involved with that.
Yeah, that's a good question. I think to your kind of point, right? Like tax preparation is probably what most people are familiar with, and that's a. But if you think about it, that's really just kind of at the end of the year, beginning of next year, right? We're talking. Let's presume we're in April, right? And we're talking about last year. All you're doing is kind of gathering your documentation, putting the numbers on the right forms, and kind of regurgitating what already happened last year, right? So whereas tax planning is more of, hey, what are we planning for that's coming in the next year? What are my goals? I'm looking to, scale my investing portfolio. I'm looking to build this business. I'm looking to hire some new people, whatever it is. What are the goals and what are the steps to get there, and be proactive about it, right? What do I need to put in place now? What do I need to, hey, I'm looking to sell this property in 3 months. I might have some gain here. I might have this going on. So how do I kind of get that all to work together, as a system, if for lack of a better term, right? So it's more of a kind of sitting down with your team of advisors and planning out planning out the next year or 2 years, whatever it needs to be. And it could be as simple as emails, it could be a simple phone call, whatever the case may be. But it's definitely encourage people to do that planning, because you have a lot more options and strategies available to you talking about it ahead of time versus like coming and dropping your stuff on April 10th and
Oh,
saying, this
by
is
the
what I did
way,
last year. Yeah.
yeah. I love that. And I remember when I had this like epiphany moment of, oh yeah, I should be doing prep work and be playing offense and being proactive as opposed to being reactive. This light bulb just went off in my head of like, oh, and you touched it perfectly. I think I had more options as opposed to,
Right.
hey, this is what I did. And my CPA goes, okay, well, this is the answer. This is the result then, as opposed to, hey, what if I did this? Or what about
Right. Right.
doing
Right.
that?
Right. Right.
And then they go, oh, well, then this, you have A, B, C, D, E as your options. So
And the
I
same
love
thing,
that.
we were, talking about expenses earlier, right? Like I think, great example of that is people talk a lot of times they're asking their tax person, maybe again after the fact, maybe it's ahead of time, but like, hey, can I deduct this? And most CPAs, tax people will say no 99% of the time. But if you change your kind of frame of mind, right? Like, how can I do this? How can I take a deduction for this?
Yes,
How can I make it tax deductible? How can I do something 2 months from now that's going to save me taxes? All those kind of same change that frame of mind and how we're thinking about it and going about our planning process. I think goes a long way for sure.
totally. Totally. No, I love that. I love that. Matt, I'm curious. We're recording this end of June 2025. There's some pretty major legislation that's being talked about going through Congress right now. Can you talk about some of the implications that may or may not be impacting real estate investors? Because today we don't know what's officially going to be in the bill, but would love to know what could be coming down the pipe for us investors.
Yeah, I'm sure. I'm sure. Like me and like everyone else, we'd love this bill to get resolved sooner than later, right? So we can have some clarity on
So we just
what the heck is
know.
going on in the tax world, But yeah, so right now, as we currently are sitting here, the bill has gone through the House. And the Senate is sitting with it and kind of coming up with their revisions, for lack of a better term, right? And they've kind of documented some things of what the Senate wants, but nobody's come to an agreement. But I think some of the things that look like they're probably going to stick, I guess, for lack of a better term, right, is they're especially for real estate, and great thing for real estate investors. They were talking about bringing back bonus depreciation. So we've had, with rental properties and fixed assets, we can depreciate things over certain lives. For the last 8 years, they've had kind of a way of doing it a lot faster under this bonus depreciation method. And some assets you can take 100% bonus depreciation in some years, where it means you write it off basically right away instead of over 5 years or 15 years. that has been scaling down over the last 5 years, and they're talking about bringing back 100% bonus depreciation. So that would be huge for real estate investors, business owners, when they're putting new assets in service. And if some aspect of your rental property you can depreciate right away instead of over 5 or 15 years, that's going to be a huge, kind of reduction in income for you, and definitely better for real estate investors all around. So we're keeping our fingers crossed. Like I said, what I read is that the Senate is in favor of that, just like the House was. So that looks like it's pretty, should be not a. If I'm a betting person, I'm going to say it's going to go through. But I wouldn't bet my money. I bet Michael's money on it. But
I would say you heard it here first, folks. Matt's making predictions. I love it. So when it doesn't pass, you find Matt.
Right.
All right. So bonus depreciation, that's great. Anything else that we need to have on our radar?
Yeah, I think, that's a big one for real estate investors. They are talking about kind of making the current tax rates permanent. So they did reduce them a couple of years ago from like the highest rate was like 39.6 down to 37. And they kind of dropped some of the other brackets. They're talking about making those tax rates permanent. So that would be a good thing, because if they didn't do anything, most people don't know this, but the tax rates are actually set to go back up in 2026. So we're at the last year of the Tax Cut and Jobs Act that came out in 2017. So if they don't do anything, rates are going to go back up. But it sounds like they're going to kind of keep that in place. They are a lot of talk about state and local taxes. They put a limitation in place years ago, back in 17, that kind of capped it at like $10,000 for on people's personal tax returns. They're looking to kind of increase that. I think the talks is around $30,000 or $40,000 for pass-through businesses like S corporations, like we are, partnerships. There's a way kind of, for the companies that pay those, it's called pass-through entity tax. They were, the House wanted to kind of limit that for like service businesses like CPAs and doctors and attorneys, but not for other businesses for God knows what reason, right? But everything I'm reading from the Senate is they want to kind of balance that playing field for all pass-through businesses. So that would be a good thing if for people who have kind of service-related businesses. Okay. So yeah, there's a lot. There's a handful of things. I mean, it's I guess the big question is when, right? Like, is it going to be July? Is it going to be September? It seems like they're leaning towards Q3, obviously, or we're almost the end of June, right? But versus Q4. So I guess that would be a better thing from a planning perspective. We have a little more clarity on when you can do things, but
more time. Yeah.
Yeah.
Okay. Well, Matt, talk to the newer investors that are listening about bonus depreciation and just depreciation in general. And why is that impactful? And let's quantify it for people. Let's put some numbers to it if we could, and just talk about how impactful it is.
Yeah, I mean, I like to say that depreciation is like the ninth wonder of the world, but that's just me and my lame tax jokes, But
I love it.
No, it's I think if for those new investors out there, right? Like, great way to think of it is compared to you go out and buy stock of some company, pick on Google, Apple, whoever you want to pick on, right? Like, you pay $10,000 for stock, you don't write off the cost of that stock right now. You don't even write that off until down the road whenever you sell it. So you've made an investment, totally fine. Everybody understands that, right? But the difference with rental properties, we go out and buy rental properties. The IRS actually allows you to write off a portion of the purchase price of that property every year against the income that you're generating from that property. So let's say you've gone out and rented out your property and you made $5,000 of positive cash flow from that property for the year, which is great. But with depreciation, if you're doing it correctly, you may not have to pay tax on that $5,000 of cash flow. So that's $5,000 of cash in your pocket. But because they allow you to, quote unquote, write off a portion of purchase price for normal wear and tear, that's $5,000 out of pocket that we may not have to pay tax on right now. So that's a huge win from an investing perspective. And that's why we love it from a tax planning perspective, because it's a way for you to make money and kind of reinvest that cash flow without having to pay tax.
Totally.
And there's certain ways you go about doing it, right? There's rental properties, residential properties we can usually write off over 27 and a half years. But there's things in those properties that are considered like 5 and 15-year assets, like furniture, appliances, landscaping outside, that kind of stuff that you can write it off a little bit faster, 5, 15 years. But then when we talk about bonus depreciation, all of a sudden some of that stuff might be at 100% right away. And so it's another way to kind of supercharge some of those write-offs that maybe you're offsetting cash flow, maybe you're offsetting other income on your tax return, depending on your situation. So it can definitely become powerful.
Okay, so let's dig into that a little bit more. So we had the $5,000 in positive cash flow. Let's say we had $7,000 of depreciation based on the percentage of the purchase price. So we've got this extra $2,000 that's a paper loss. What do we do with that?
Yeah, no, that's a great question. So, I mean, I think a couple things come to mind right away is, looking at what else does that person have on their tax return. Maybe they've got other passive properties they invested in and also making money on paper. They can use that $2,000 to offset that. Maybe they've invested in somebody else's business. They're getting a K-1 that shows positive income. They can use that $2,000 to offset that, so not paying tax on that. Maybe they're working a W-2 job. Maybe their spouse is working a W-2 job and they're doing real estate. If they happen to be making, doing real estate full time and there's ways to kind of get there and plan for that, they could be using that $2,000 loss to offset their spouse's W-2 income. If they're making less than $100,000, the IRS definitely allows you to do that without having to be in real estate full time. So lots of different ways to, skin it, but it's a great opportunity that, again, I don't think exists with a lot of other investing out there.
Totally. Okay, so I just want to highlight what you said for a minute, because you said it really quickly because it's so ingrained and you're so familiar with it. But for someone listening, they may have missed it. So what you said is that $2,000, if somebody is making at a W-2 less than, was it $100,000 or $150,000?
Yeah, it starts at 100, but yeah, we can talk. Yeah, so basically, if someone's making, and we have this all the time, we've got new investors come to us, right? We work with, runs the gamut of new investors all the way to kind of the full-time seasoned investors doing 5 different types of real estate, right? But those new investors, great example is somebody that, you're making a $100,000 W-2 and you go out and buy your first rental property. And if you kind of find ways to kind of maximize your deductions, like we talked about, ways to kind of maximize your depreciation on top of that, we've seen it where people can get a $25,000 loss on paper from that rental property. Now, instead of paying taxes on $100,000 of income, they're only paying taxes on $75,000. Yes. I mean, think about it. For someone making $100,000, all of a sudden you wiped out 25% of their taxable income, and they're, I'll say they're 25 years old, whatever. It doesn't matter how old they are, but for somebody in that situation, that's a game changer, right? I mean, that's setting them up for huge success for the next 5 to 10 years, getting that kind of ball rolling.
Yes, no, and so that's exactly the point that I was hoping you would make, is that you can use some of the depreciation or paper losses from the rental property to offset the W-2 income that you're earning on a daily basis and truly change your tax bracket, change your tax situation from your W-2. And so, I mean, could somebody get it all the way down to zero? Let's say they bought this massive apartment building somehow. They've got $100,000 of depreciation. Could they offset all $100,000 of their income, of their W-2, and essentially pay zero federal tax?
They could in a situation if maybe they had a spouse who was not working, but working on real estate full time and, qualified as a real estate professional. If it's just a single person working a W-2 job, the most the IRS is going to let you write off there is $25,000 of a cap. But yeah, we've got, clients that are, got a spouse who's working full time in real estate and using the real estate rental losses to offset their W-2 income from the other spouse. And that can work wonders as well.
Yes, totally. And so, so what's the limit on if you've got a partner or a spouse that's working full time in real estate, you're making good money at your W-2? Is there a limit on how much you can write off?
Yeah, I mean, the most right now, it falls into this thing called excess business loss limit, but it's around, for like a married couple, 2 people filing a married joint return, it's around $600,000 of just net rental loss, absent anything else going on that you could offset against W-2, interest, dividends, capital gains, whatever else you have. So somebody theoretically in the right fact pattern could make $600,000 income, and if they had enough real estate, enough depreciation, they could get it down to zero taxable income for sure.
This is insane. Like, that doesn't make you excited about taxes, I don't know what else to tell you. Okay, so this is great. So let's keep gaming this out. So you're making $100,000 at the job. You've got a $25,000 as a single person. You've got $25,000 limit. let's say you do some of this bonus depreciation, and now you've got, say, $50,000 in depreciation to use. What happens to that extra 25? Is it just kind of lost, or how can we use that? Is it a next year type of thing?
No, that's the beauty of it. Is it doesn't get lost. You basically get to carry it forward to the next year, and so you can apply it to your rental loss the next year, and then look at the same rules. So the next year, let's say you've kind of taken a big chunk of depreciation up front. Maybe there's and maybe just keep it conservative. You don't buy another property next year. So, but we still got the same rental property. I'm still making $100,000. If I've got, I used 25 of it last year. I got 25 more carrying forward to this year. Now we can use it, deduct that 25 against your 100 again. So now we've sheltered $50,000 over 2 years. That's pretty powerful. So that's a cool thing. Is you don't lose it. It just carries forward. Kind of look at how can we utilize it in a subsequent year.
I love it. So, Matt, something I've always wondered is we always talk about like income limits, or if someone's making $100,000, like we're talking about, is that their gross income, or is that the net income? Because the person that's making $100,000 of their job maybe is contributing to a 401k, maybe has some medical healthcare contributions that they're responsible for, and so their take home is going to be less than that. So what number are we talking about here?
So it is based on that rule specifically is based on adjusted gross income. So that would be after taking out 401k contributions. If they made like an HSA, a health savings account contribution, stuff like that. It's before itemizing their standard deductions before you get the taxable income. But yeah, to your point, that could be somebody making $120,000 of W-2, but they put 20 into their 401k. So they've got themselves down below that $100,000 limit, which is huge. And then they can add that to it. So not only have they sheltered income from their 401k contribution, they can also shelter some more with the rental real estate loss.
And so this exact thing, everybody listening, is the reason you need to do tax planning sessions and not just tax prep. Because somebody listening out there could be making 125, heard us say, oh, you got to make 100,000 or less, and thinks, that doesn't apply to me. It totally does. You just need to work with your tax professional about how much money do you need to squirrel away in a pre-tax account, or rather, pre-tax account in your 401k or something like that, to get yourself into that threshold to be able to take advantage of some of this stuff. So,
great example of this, right, is like somebody, we see this all the time. That's, maybe they're getting into their first property, right? Their own primary residence, for, if you want to call it that. Look at a house hack, right? Buy a duplex where you live in one unit, rent out the other unit, and it's easy to self-manage because obviously it's next door, and it's, you're kind of getting your feet wet with real estate investing, right? It doesn't have to be, people are like, oh, how am I going to buy my own primary and buy a rental property? Well, buy them at the same time, right? Like, do it at once. You see this all the time.
Yeah, I love it. And so how does that work from a tax perspective? Because you're living in part of it, but you have a rental property as part of it.
Yeah, then we're just splitting expenses, right? So now we got, keep it simple, right? If each unit is 50% of square footage, then we're taking 50% of the expenses are personal, 50% are rental property expenses. We can depreciate 50% of the cost basis. So again, if we can get the number, buying a certain amount of property, generate a certain amount of depreciation, definitely can use that strategy. So it's a good way to kind of get your foot in the door with respect to real estate investing and still building wealth for your own, not paying rent for a primary residence somewhere else.
Totally. I would actually push back on that and argue that it's a great strategy, regardless of where you are in your investing journey. So it's something my wife and I did like at year 10. We were like, oh, this is an expensive market we want to go live in. And so we house hacked for a couple of years, and we're like, this is amazing. This is so great. So, okay, but talk to us, Matt. So taking it a step further. So, okay, I'm house hacking. I'm living in half. I'm writing off the other half of the expenses. Now I move out. I've exited the house hack. I've completed the house hack after 1 year, 2 year, whatever the time frame is. What happens to the expenses on my half that I have now converted into a full rental property?
Well, the beauty of it is that now you can turn that into a rental property, right? So you can start depreciating the other side of the property now against your rental income. And basically kind of now you're doubling up on those expenses. Now they're all rental expenses. Cool thing about that, I don't think a lot of people know is not even just a house hack, but like, let's say you lived in a house for 2 years, you owned a property, lived in it for 2 years, you moved out and rented it for 1, 2, 3 more years. There's ways that you could sell that property with, by before the end of, let's call it year 3 of renting it out, utilize that primary home sale exclusion. So, everybody, a single person can sell a primary residence and get $250,000 of tax-free gain. Married couple can get 500. You can still use that if you've lived in a property, moved out, rented it for a couple of years, and then you sell it. So you can still use that exclusion. You could also, you and I were talking offline about 1031 exchanges. You could then 1031 exchange property because it's still a rental property. So we'll see that a lot. There's ways to kind of double dip for for lack of a better term, right? But yeah, it works out in the right situations where someone's like, well, I want to keep it as a rental. It's like, okay, well, it's got a lot of appreciation. Maybe we should revisit this in, year 2 of it being a rental property and see if there's a market for you selling it and reinvesting it and taking some tax-free income and then still buying more rental properties.
So if I heard you right, if I'm a married couple, let's say I bought a house for $1 million and lived in it for 2 years, 3 years down, and then I move out after 2 years living in it. Now I've rented it out for 2 years, and now let's say the market's gone gangbusters, it's worth 1.6. I go to sell the thing, 500,000. I've got a $600,000 gain. 500,000 of that I can take tax free, but if I work with a tax planning professional and structure this right, I can also 1031 exchange, so I'm not paying capital gains on that extra 100,000 over the five.
It's the beauty of it is, hey, you can take that 500 tax free gain and then do a 1031 exchange to defer having to pay tax on the other $100,000 of gain, and then kind of keep pushing the, on the new rental property, push that tax can down the road, right?
This is incredible. This is just incredible. Okay, so getting back to the house hack for a moment, because I think it's such a common and wonderful strategy for people to utilize. There is something in the tax code about mortgage interest write-off from an owner-occupant perspective. There's a cap on that, right? I think it's like 750,000 or $1 million.
Right. Yeah, you can deduct interest on right now on a loan up to $750,000. So if you have a loan that's anywhere from 0 to 750, you're deducting all of your interest. If your loan is more than 750, you're getting kind of a prorated amount of your interest deduction.
Okay. And so how does it work for, let's say, this $1 million house hack property? I've got an $800,000 loan on it. Am I able to deduct only part of the interest because it's greater than 750 and I'm living in half the property? How does that work?
Well, so yeah, in that example, beauty of that is that only, running the math, if it's 50-50, right, on your primary home mortgage is only $400,000. So you're deducting interest, that full interest on the $400,000 as your personal interest, and then you've got an interest deduction on your Schedule E for your rental for the other $400,000. So you actually get to, at the end of the day, deduct more interest than you would if you were just living in that property by itself.
Amazing.
Yeah.
And then, okay, so we're deducting the depreciation for half the property for the rental half, because depreciation isn't a thing for primary residences. Right. Now I've moved out of the property. Now I grab that additional 50% depreciation that I was just leaving on the table and now can add it to my tax return?
Yeah. And then you kind of start the clock ticking on that portion of the basis and start depreciating from that point forward for sure.
This is just unbelievable stuff, Matt. This is so cool. Okay, so what do you see like the sophisticated investors doing? Because I think a lot of this is really attainable, is really digestible for beginning investors. What are things that people should keep in their back pocket, keep front of mind as they're growing their portfolio, as they're looking to scale, and maybe take advantage of some more sophisticated tax strategies?
Yeah, I think the thing that probably successful investors are doing is they're at the same time as they're kind of learning the product, but they're building their teams, right? So they're getting that real estate, that asset protection attorney on their team. They're getting that estate planning attorney. They're getting their tax strategist, tax advisor on their team, and runs the gamut. You got your real estate agent that's kind of in your back pocket that's finding you those off market deals, all that kind of stuff, right? They're building their team so that they can kind of learn from everybody at the same time. But yeah, I mean, a lot, kind of more sophisticated investors of ours are, they're doing real estate full time. They are getting into maybe they can't do real estate full time, but they're looking at utilizing. They're investing in short term rentals where they can kind of do it as a side hustle and start using some of that same strategy and the benefits of the real estate without having, even if they're making more than $100,000 because they're investing in short term rentals. So that's another thing that some of our clients that are maybe still working full time in their W-2 job, but they're now expanding to, or wanting to invest in short-term rentals instead of, long-term rentals.
Okay. And you touched on it, but why would somebody do that? What's the, like, if someone is listening to this show, they make $200,000 a year at their W-2, real estate investing full-time is not an option for them. They love what they do, but they're determining what strategy do I want to go pursue when it comes to real estate investing? Why did you mention?
Yeah. The reason that's key is because the IRS treats short-term rentals differently than every other type of rental property. So they look at it as more like there isn't that $25,000 cap that we were talking about earlier in terms of a net loss that you can deduct. There's no cap there. So they look at short-term rentals differently. So if you just happen to invest in one or two short-term rentals, you self-manage them, you meet what they call the material participation requirements, which there's different ways you do it. But if you're self-managing the properties, it becomes not that hard to get there, I guess would be a good way to say it. And there's ways that we've got clients making $200,000, like you said, in that situation, and taking $50,000, $75,000, $100,000 write-offs on their properties because of bonus depreciation and cost segregation. They're putting a lot of furniture, because it's furnished short-term rentals, right? So the expenses can be a little more upfront, but the return on investment from a tax perspective can be pretty substantial.
I love it. Okay, you also mentioned this term cost segregation study, which I'm like the biggest fan of since sliced bread. But for anyone unfamiliar, tell us, what is a cost segregation study and why is it valuable?
Yeah, it's definitely not something that's for everybody, right? It's not a run out to the back of the room and do your own cost seg study because you heard it on a podcast somewhere. But in the right circumstances, what it does is it takes that, we talked about earlier how we depreciate properties like residential properties over 27 and a half years, commercials actually over a longer period like 39. But what a cost seg study does is there's firms out there like engineering firms that come in, they're experts at this. They look at the property and say, hey, some of the stuff in here is not really a built part of the building. It's really kind of segregated property that we can depreciate much faster, 5, 15, 7 years, something like that. And so that by itself is beneficial because now we're taking a depreciation write-off sooner than later. You're still getting the same amount over the life of the building, right? Over 27 and a half, you're still getting the same amount of depreciation. But if we can take more of it sooner and we can use it, then why wouldn't we? And then when you add that power of the bonus depreciation that we were talking about earlier, a lot of those 5, 7, 15-year assets are eligible for bonus depreciation. So now the cost seg becomes even more powerful because, hey, on a $500,000 building, you might get $50,000, $75,000 of basis allocated from the building to 5-year property. Well, instead of that being written off over 27 and a half years, now all of a sudden we're writing it off right away. I mean, that's a huge swing in your depreciation expense, right? So, again, for someone who can, use it right away, or they got a lot of other income from other rental properties they can use to offset, it becomes a powerful strategy for sure.
So talk to me about, because maybe I'm still just a little bit confused, Matt, about bonus depreciation versus a cost segregation.
So you basically kind of combine them together, right? So the cost seg, what a cost seg does is it's saying, hey, these assets are not 27 and a half year assets. These are 5, 7, and 15-year assets. That's kind of what the cost seg is doing. Okay. And then you get to a 5 and 7-year asset. How do I depreciate this? Well, it's either you do it over 5 years, or you do it over 7 years, right?
Right.
But then when they bring bonus depreciation, you tie it on top of that. It's saying that 5-year asset that's $50,000. Well, now we can write it off over, if it's 100% bonus, we can take it in 1 year instead of $10,000 a year or whatnot,
And so if I'm someone listening and I've got a rental property, do I have to go do a cost segregation study to take advantage of bonus depreciation? Or can I just bonus depreciate with my CPA stuff all on its own?
So it's for people who are investing in properties and, furnished properties, and you're putting a lot of your own stuff in there, like furniture, appliances, stuff that you have receipts for that you paid for separately from the building. You can certainly do that with your CPA, and you should be going through that exercise, looking at like, what did I spend my money on in this property, and how do I maximize these depreciation write-offs? Maybe some of that is depreciable. Maybe some of it's a repair, that you can expense anyway, right? But you should definitely be going through that step. But sometimes when you buy the property, there's stuff attached to the building, like cabinets, flooring, other things like that, landscaping that is you're going to need to do a cost seg study to kind of break that out of the building on paper, because if you just do it yourself and you were to, from a risk perspective, you were to get audited, the IRS would kind of, they would throw that out because you didn't quote unquote use an expert to do it for.
Right. That makes sense. Okay. All right. Great to know. Great to know. From a depreciation standpoint, you said residential is 27 and a half years, commercial is 39. So if I've got a 7-unit apartment building, is that commercial or is that residential?
Yeah, it's a great question. So it's, this comes up a lot because I think, people think like, oh, I went out and bought that 7-unit building or 4-unit building and I got a quote unquote commercial loan on it, right? Like,
yeah.
But it's based on how, what the property is being used for. So that's being used for residential living. So that would be a residential property for depreciation purposes.
So if I've got
versus like an office building or a hotel,
warehouse,
or something like that,
Okay. All right. So if I have a 50-unit apartment building, that's residential. That's
still residential. Yeah.
Beautiful. Beautiful. Okay. And what about mixed use? If I've got retail on the bottom floor, apartments on the upper floor.
And then it kind of goes back to that same example, like the house hack, right? Then you would look at like, okay, well, 50% of the property is commercial, 50% is residential, and you would break it out that way for tax purposes.
Okay.
Interestingly enough, short-term rentals fall under the they are actually depreciate over 39 years. So even though you are renting it out to people, the IRS almost from a depreciation standpoint looks at it like it's kind of like a hotel. So they want you to kind of treat it that way for depreciation purposes.
Okay, that's very good to know. And then how does IRS categorize short-term rental versus not? Because traditional is 30 day or less is considered short-term.
So the way the IRS defines a short-term rental is, generally speaking, the average customer stay during the year is 7 days or less. So you basically add up the number of days it was booked divided by the number of bookings. If the math works out to be 7 or less, you've got a short-term rental. If it's 8 or more, you've got a long-term rental. The one exception to that is you're kind of referring to as we'll call it the hotel exception, is if the average stay is 30 days or less and you're providing kind of like what hotel type of services hotels would provide, like daily cleaning, you're changing the towels and the linens and all that stuff. You're providing kind of room service or concierge type services, which some people do with their Airbnbs and short-term rentals. A lot of people don't, but some people do. And if you can make money doing it, then do it, So if you're somebody who's providing those services, then your stay can go up to 30 days. The average stay can go up to 30, and you still have a short-term rental for tax purposes. So that can be beneficial in the right circumstances for sure.
Okay, interesting. So Matt, talk to me about the person that's making $200,000 a year at their W-2. They own a bunch of long-term rentals. And so they're not materially participating, but maybe they're self-managing. Maybe they're doing all of this stuff. Is there any like tax benefit for them, or are they still limited to how much they can write off? Or maybe they can't write off anything above and beyond because they're making too much money.
Yeah, it's for somebody like that, it's going to come down to how much time they're spending in real estate versus their job. So if they're working a full-time job, they're working 2,000 hours a year. In order to kind of deduct rental losses against W-2 income, in full without limitation, the IRS is going to say you have to spend 2,001 hours a year in real estate. Most people aren't going to do that, obviously, right?
Yeah.
But if they are, again, maybe it's one spouse is working full-time, the other one's stay at home, maybe working part-time, then if they can kind of get to that real estate professional status, which is just a tax terminology, but it just basically means, to your point, did you spend more than 750 hours a year on real estate? Did you spend more time on real estate than your other job? And again, if they're part-time and they don't have another job, then that one's out the door. And then are they meeting the material participation requirements? Are they self-managing their rental properties? If so, then they can use their rental losses against their W-2, usually without much limitation. Well, we see some people doing that maybe they're making $200,000 and they're kind of got a portfolio of long-term rentals, but they're not going to qualify as a real estate professional. Well, maybe convert one of those to a short-term rental. Maybe convert it to a 30-day stay or something like that, where I don't need to be a real estate professional. I can use a short-term rental loophole instead. So we'll see that happen sometimes. And that's where the planning comes into play, right? Like
yes.
Hey, what's the next year going to look like? What is your goal? Are we trying to scale real estate? Are we just trying to kind of save on taxes? Are we trying to do both? What is it? And then we can kind of find the strategy that works in your situation.
I love it. And there's like, this is, if you can't take away from this conversation anything else other than the fact that real estate is so versatile and so beneficial from a tax perspective, don't worry about the cash flow. Don't worry about depreciation. Just if you only look at taxes and how it impacts your like overall financial picture and return, it starts to blow these returns up. And to be like, oh, I'm only getting 6% cash flow or cash on cash return. I'm like, yeah, but you're looking at like one slice of the pie, and that's usually the smallest slice. Look at all this other stuff, and they're like, oh, I didn't know about that. So go back and re-listen to this episode.
Right. And that's the thing. It is, from a tax perspective, it's versatile year to year too, right? Like one year the property could be a short-term rental. The next year you can convert it to a long-term rental because the market changes and you're going to get a better return on it. You're not stuck, like you're not pigeonholed, it doesn't have to be the same thing every year. So you're going to want to evaluate that every year and say, hey, like what's changing? What's, maybe you've changed jobs next year. Maybe your income's going to go down. Maybe you've cut back on your hours. 10 different things could happen, right? So that you could plan for.
Yeah. No, this has been so great. Just I'll share a quick anecdote with everybody, Matt. So I did a cost segregation on a massive development project that I did out in the Midwest. I had crazy amounts of depreciation and write-offs that I wasn't able to use. So they got banked, just like you said. And then I ended up selling a property a couple of years later, and I didn't really want to 1031 exchange it. It was a headache property. I just needed some cash in my pocket. So I sold it and paid zero capital gains because I had this depreciation on the books, essentially. So I just got to put money in my pocket. So like you said, it just having it in the bank, in like your tax bank, is so valuable because it just gave me the option to do that. Had I not, it would have been a very different situation. I would have paid a lot of capital gains tax or had to 1031. It's something that I really wasn't looking to do.
Yeah. And I think that's kind of, I love that because that's, it's a nail on the head in terms of the planning aspect of it. It's like, what are these tax attributes that I have? What are these things that I can utilize in the future? Because people might find themselves in the same situations like, hey, I bought this property for $1 million and it's gone up to 1.5 and I'm expecting to have a huge tax bill. Well, maybe, but
right.
Maybe a 1031 exchange is an option. Maybe opportunity zone is investing is an option. Maybe you've got some tax losses, maybe not even from that property, but from some other properties that have been banked and carrying forward that now can be used to offset the gain on the sale of this other property. And you're like, oh, hey, I just went from $500,000 a gain to $100,000 a gain on paper. Well, that's a different conversation, right? Like that makes a huge difference in what you're planning to do and from a reinvestment perspective and everything. So I love that for sure.
Awesome. Matt, dude, this has been so much fun. I mean, we could go on for literal hours talking about this stuff. I'm a tax nerd like you. So
I can see it. I can see it.
The wheels are constantly turning. Matt, you wrote a book, right?
Yes.
What's it called and where can people find it?
Yeah, my wife and I are published authors. That rumor is true. We wrote 2 books. They were published by Bigger Pockets, so you can get them on Bigger Pockets or Amazon or wherever books are sold. But the first one is Tax Strategies for the Savvy Real Estate Investor. It's kind of we'll call it the beginner book. Kind of goes into foundational strategies and things like that real estate investors should kind of think about. And then the other one is the kind of more advanced book. It's Advanced Tax Strategies, Cracking the Code for the Savvy Investor. So don't blame me for the long titles. That was the publisher's suggestion. But yeah, thanks for asking. We wrote them as kind of their story formats. So we've read lots, CPAs, we read lots of tax books and, a lot of stuff is written by CPAs. It's pretty boring stuff, obviously, as you probably experienced over your life, right? But
yes.
So we wanted to write it from like hey, how do we make this interesting and entertaining? We kind of took some client stories, changed their names to protect the innocent, but like told them in ways that like, hey, these are the things that kind of worked. These are the things that didn't work. Like try and avoid these, So, but yeah, it's they're easy reads. Like, you can probably read them a couple of days, but
yes, I can attest to that.
Yeah.
They're both very well written. So thank you for that. Cause it made reading about taxes much more interesting and exciting.
Yeah, who would want some late night tax reading, right? Like,
right. Everybody and their brother and sister,
right?
Matt, this is so fun, man. Where can people reach out if they have more questions or want to reach out about your services?
Yeah, the best place to find us is on our website. It's KeystoneCPA.com. We have a lot of information on our free resources, links to our kind of YouTube and Instagram and all that kind of good stuff. So we post things a lot. My wife, Amanda, she's on there all the time on social media. So you can find her as Amanda Hahn CPA. She's always putting tax tips on there as well.
Awesome. Well, I will definitely encourage people to go check that out. And thanks again, Matt. We'll definitely be in touch, man.
Yeah, thanks for having me again, Michael. Appreciate it.
You got it. Take care. All right, everyone, that was our episode. A big thank you to Matt for coming on. Tons of changes coming down the pike, but also tons of things that have already been in effect that you can take advantage of starting today as a real estate investor. So definitely do not sleep on this stuff. Go check out Matt and Amanda's resources. And as always, we love hearing from you. Ratings, reviews, comments. Let us know what you want to hear more of, what you want to hear less of. And we look forward to seeing you on the next one. Happy investing.